Hello there, welcome to lesson 2 of the Equity Masterclass by Already Late, your favorite personal finance channel. In the previous lesson, we saw how it makes sense to invest in equities over a longer period of time and how the probability of making money increases as you increase your time frame of investment. In this lesson, we will understand the two most distinct ways of making money in equities. The first way of making money is very obvious and perhaps known to you as well. It's very simple, buy a share at a lower price and sell it at a higher price. Let's take a simple example. Let us go back to near history, let's go into a time machine and let's just go back and buy one share of HDFC Limited on 1st of October 2010. The price of HDFC on 1st October 2010 was 742 rupees. And let's say that you hold on to that share for a little over 10 years and sold it on 23rd November 2020. The price on 23rd November was 2,250 rupees. Now this transaction resulted in a profit of over 1,500 rupees, which comes up to over 11.5% returns per annum. And you could make this profit by buying a share and hanging on with it, not selling it for a really long period of time. Now, this is the most common way of making profits through equity investing. Now, before I move to the second way, there are two important points which I wanted to share with you and that you should always remember, especially when you are investing in equities. First, investing and sitting back is one of the most difficult things to do. It is just not in our nature, not in your nature, not in my nature to not do anything. And equity markets will make it even tougher for you. There will be instances when the stock is not moving for a really long period of time. And you all of a sudden start doubting your investment decision and even start questioning the rationale behind market behavior. Now take the same example of HDFC where we had invested, in 2010 and made 11.5% returns per annum for over a 10-year period. Now I'll just share two particular phases during this 10-year period. The first phase was between October 2010 when we bought it and October 2012. That's 2 years. Now at the beginning of October 2010, as I said, the price was 742 rupees. And at the end of October 2012, it was around 760 rupees. Now let me ask you, what would your state of mind be if you had bought HDFC at 742 and you see 2 years later, 25 months later, it's still at around the same levels. And to make matters worse, during this period, HDFC went to a low of almost 590 rupees. Now, would you not be tempted to look at some other stock? Or perhaps just leave equity investing completely. You just give it up. Now, the second phase, you can see, again, let me show the chart. January 2015 and January 2017. Very similar sideward movement as we saw between 2010 and 12. Now, in January 2015, the share price was 1,315 rupees. And at the end of 2 years, January 2017, we still see the same prices, 1,366 rupees to be precise. Now, if by any chance you had resisted the temptation of selling the share in the 2010-12 phase, the difficult phase, if by any chance you had got over it without selling the share, you are once again in the same dilemma. You're asking yourself, is it the right time to exit from HDFC now that you have decent profits? Or should you continue to remain invested? So in the 10-year journey, you saw that for over 4 years, there seemed to be no action at all in the stock. And yet at the end of the 10-year period, you see there is a return of 11.5% per annum. Now this was the first point, and your lesson from this point is very, very simple. If you have done your homework right, if you have the right stock, you should really not get bothered with what's happening to the stock prices, even if they're not moving for a relatively longer period of time. If you have done your homework, have faith in your abilities, have faith in your work. Don't get disturbed, don't get distracted, don't get perturbed by the lack of movement in the markets. The second point is that along with sitting back without any action, you need to ensure you have done the homework in the right way. Let us say instead of HDFC, you bought DLF in 2010. Now DLF back in 2010 was one of the big names, IPL and whatnot. And you decided that yes, DLF is the right stock, and you decided to stay put and do nothing for the next 10 years. So the price when you bought DLF 10 years back was around 385 rupees. And after 10 years, now the price is at around 185, less than half of what you had invested. A major financial disaster. What I am trying to tell you is that while it is important to sit tight, it is equally important to ensure you have the right stock. Sitting tight and not doing anything will only help if you have bought the right share. So if you sit tight in a boat which has a hole, it is only a matter of time before you just drown. So before buying, please ensure you have bought the right stock. And this is what I intend to achieve through these lessons in the Equity Masterclass. Help you identify the right stock for investing. Now this was about the first way of profiting from equity investments. Buy right stock at lower prices, sell at higher prices after an extended period of inactivity. Now let me tell you about the second way of making profits from equity investing. This is often not very visible, and a lot of youngsters which I have seen, new investors who I have seen, they ignore this part of equity investing. Profits can be made in the form of dividends. What is dividend? I am sure you know dividend is that part of the money, that part of the profit which the company has made, which is being paid back to the shareholder. So the company's made certain profits, it decides to pay back to the shareholders. And you being a shareholder, you receive that money. So the key word here is profit. If a company is paying dividend, you can be sure that it is a profitable company. Now, does this mean that a company which is not giving dividend is not profitable? No, not at all. While dividends are paid out of profit, it is not compulsory for a company to pay dividends. There are many instances when companies will decide to retain the entire profit for its business purposes. Could be expansion, could be acquisition, could be growth. So let us get back to dividend as a way of making profits from equities. There are a lot of companies which pay high dividend to the shareholders. These are companies which are usually rich in cash. They have a lot of cash and are not in a major expansion mode. To understand the power of dividend as a source of earning, let me again take you to a simple example. Look at this chart. Now this is how the prices of REC, Rural Electrification Corporation, has moved over the last decade. If you see, the stock price has not moved much and stayed in a very narrow range. If someone had purchased a share of REC somewhere in around, let's say, April 2011, the price of each share was around 120 rupees. Today, after holding it for nearly a decade in November 2020, the price is still at around 120 levels. This means that you have made nothing at all in this long investing period of almost 10 years. Now, during the same period, of course, there have been 18 occasions where the company has given a dividend to its shareholders. Now, put together all these 18 occasions, the money you have received over 150 rupees as a dividend, resulting in a return of over 10% per annum. So when prices of a share increase, making money is accompanied by a lot of excitement because it gives you a lot of adrenaline rush. You see the prices going up and down. You can, after all, talk about your achievement and show off your stock identifying skills. On the other hand, dividend works silently, and if planned well, dividend alone can cater to all your retirement needs. Now, please note that all the examples that I have used here and also use in the future videos are just to make the concept clear and get you a deep understanding of how actually markets work. Please do not consider them as investment recommendations. By now, I am sure that it is clear to you, you can make money in equities through increasing price of shares and dividends paid by the company. Now imagine the kind of returns you can make if you can identify stocks that has a combination of both of these, a little bit of dividend, a little bit of capital appreciation. This would just be like a train with a double engine. Would you not want to be able to identify such stocks on your own? Stay connected for further videos, further lessons of the Equity Masterclass to learn about the nuances of stock picking. In my next video, I will share the 3 roles that you will play as participant in equity markets and how you can use these 3 roles to get the most out of your money and most out of your time. And if not managed, this could be the real wealth destructor. Until then, don't forget to like, share the video. Don't forget to learn. And don't forget to subscribe to my channel if you have not done it yet. Thank you. Happy learning.